Hi, everyone, this is the Encyclopedia Channel. The book that this program interprets for you is The Logic of the Rich, which emphasizes an important point that the reason why the rich can have a lot of wealth is because they have different common cognitive logic. So, how do rich people view wealth? What qualities do they have in common? If you want to become rich, what inertial cognitions need to be overcome? After reading this book, you will understand why. When we mention the topic of investing to make money, many people first think of the stock market. But in 2012, German scholar Schmallenbrock conducted a survey. She interviewed 472 rich people with an average asset of more than 2 million euros, and found that less than 2.4% of them said that the stock market was their main source of wealth. Through this survey, we found that there are many cognitive differences between ordinary people and rich people when it comes to creating wealth. For example, ordinary people like to look for opportunities to make a fortune in the stock market, like to diversify their investments, and always think that people who start businesses are the people who dare to take risks the most. The logic of the rich is often the opposite. It is precisely because of their unusual cognitive logic that they finally achieve financial freedom. The so-called financial freedom means not relying on passive work to make a living, but relying on income such as investment to live the life you want to live. The author of this book, Rainer Zillmann, is the senior editor-in-chief of the famous German newspaper Welt. He is very flexible in mind, and with the help of the platform of the newspaper, he has established a lot of contacts in the real estate industry and learned a lot of business experience. Later, Rainer opened a communication consulting company, specializing in services for the real estate industry, and now this company is very famous in the industry in Germany. Zillmann has written 17 books in total, the most influential of which is Dare to be Different, Successful People and You and Me, which was translated into 6 languages and published. Next, let's tell you about the content of the book in detail. This book mainly talks about 3 key points. The first point is to tell us that if we only equate wealth with a large amount of income, we will never achieve financial freedom. The second point is that to become a real rich person, we must learn to let the wealth continue to increase in value, but there are 5 inertial cognitions that will become our obstacles, and we must break them. The third point is that we want to become rich. 5 qualities a person should possess. First part. Let's start with why having a lot of money doesn't mean you're rich. Because the author believes that the speed of money loss is far beyond our imagination. If you don't know how to manage money, even if you have a lot of money, you will end up sitting on nothing. Let's listen to a true story first. In 2001, there was an unemployed man in the United States named David Lee Edwards. He bought a lottery ticket and won a jackpot of $27 million. After experiencing a sudden wealth, David began to buy villas, cars, collectibles, private jets, and even took drugs. Just 1 year after winning the lottery, he spent $12 million. Not long after, he spent all his money. The bank seized his property and dumped him in a warehouse. In the end, he died alone. In fact, there are many examples of such sudden wealth and impoverishment, not just ordinary people like him, celebrities are no exception. For example, the American diva Whitney Houston, when he died in 2012, still owed $4 million in debt. Studies have shown that most lottery winners are worse off within a few years of winning the jackpot than they were before winning. Because they all made a cognitive mistake, that is, they thought that with so much money, they could live comfortably. The author Zillmann has calculated an account in the book. He calculated how much savings a German would need to achieve a per capita net income of 24,000 euros in 2014 if he did nothing and only earned interest on his savings. The answer is a deposit of 800,000 euros, and still at a high interest rate. At the same time, the country cannot yet inflate, and the money cannot be devalued. This shows that having a huge amount of money does not mean being rich. In fact, keeping a sum of money is more difficult than earning a sum of money. No matter if you have 1 million, 10 million, or 100 million in your hand, if you don't know how to manage money, you will end up sitting on nothing. Money is draining faster than we can imagine. When ordinary people have some money, they generally spend extravagantly without considering investment, or even if they invest, they are relatively blind. In 2001, an Austrian warehouse keeper named Günther Scherztana received a bonus of more than 700,000 euros. At this time, a financial advisor from a prestigious insurance company in Austria approached him and said it can help him make a stable investment without losing money, and his assets will at least double in value. Schmallenbrock then took out more than €500,000 for investment, but his consultant was obviously not that capable and used all his money in stock market and currency speculation, not only exhausting his savings in 10 years. Tana's money also made him owe a debt of €100,000. Many people, like Schmallenbrock, trust financial advisors from banks or insurance companies, but author Zitelmann argues that most of these advisors are pure salesmen whose task is to sell financial products for the bank or insurance company. Insurance companies generate income and do not really give investment advice from the perspective of customers. So while it's easier to let them take care of your money, you're also giving up responsibility for your own investments and reducing your chances of making a successful investment. The rich will not consume extravagantly when they have money like some ordinary people, and they will not leave the investment to others. They pay more attention to gaining wealth through their own investment choices, so that they can always maintain what they like. Life. The rich know one thing very well, that is, how much money they have is not as important as what to do with the money. This is also the biggest difference between the rich and ordinary people. This is the first key point we introduced today. Having a large amount of money does not mean being rich. Only by allowing money to increase in value and allowing oneself to continue to live a free life is true wealth. The second part. 5 cognitive misunderstandings that must be overcome in order to increase the value of wealth in a large amount. The first cognitive misunderstanding is also a commonly heard sentence: don't put all your eggs in the same basket. The meaning of this sentence is to let us spread our funds as much as possible, such as buying many different stocks or investing in different real estate. This involves a portfolio theory, which was proposed by the economist Markowitz in the 1950s. This theory holds that if we can carefully choose the matching ratio of various investments, we can minimize investment risks and obtain certain returns. And the less correlated these investments are, the less risky the portfolio is. There is some truth in this statement, but it is not very reasonable when it is used in the matter of becoming a rich man. According to Zitelmann, diversification actually hinders wealth growth. Such a method of diversification can indeed avoid making bad investment choices, but it only makes us make fewer mistakes, but it will not increase the value of wealth too much. Zitelmann himself decided to invest in Berlin's real estate market 15 years ago, and he is now earning double-digit yields on his investments. If he had chosen to diversify his investment and only buy one type of real estate fund, the final rate of return would only be a few percent. If we don't diversify, how do we invest as precisely as the authors do? Zitelmann believes that the most critical point of investment is whether there is sufficient understanding of the market to be invested in. The information obtained from the market is usually uncertain, and we don't know what the information will eventually lead to. For example, when the government announces the news of rising unemployment, some people may think it is bad news, because the rising unemployment rate means that the economic situation is more serious, and the stock market will be affected, but some people think it is good news, because they think the central bank will be affected by it. Lowering interest rates, on the contrary, can stimulate the stock market to rise. Many transactions in the investment market can occur because there are always diametrically opposed opinions. Some people are buying, while others are selling. But in any case, in the end only one party will be right and benefit. Therefore, if you understand the market well enough, you are more likely to be on the right side. The second cognitive misunderstanding is that many people think that low volatility in the market means low risk. Market volatility, simply put, is the change in yield. This is also the theory of the economist Markowitz we mentioned just now. He believes that the lower the volatility, the lower the risk. But there are also problems with this theory. Another economist, Michael Kepler, gave an example to illustrate this problem. Suppose there is a stock that rose by 10% in the first month, 5% in the second month, and 15% in the third month. During the same period, another stock fell 15% every month. According to the volatility theory, the first stock has high volatility, while the volatility of the second stock has been stable at 15%, so the risk of the first stock is greater than that of the second stock. But in fact, although the first stock has been fluctuating greatly, its price has been rising all the time. After 3 months, its return has reached 32.8%, while the second stock has been stable in volatility, but its price has been rising. It is falling, and it will lose 38.6% in 3 months. This example shows that low volatility does not mean low risk. The third cognitive misunderstanding is that many people think that they should invest as much as possible in the local area. When investing, we generally believe that the risk of overseas investment is greater than that of local investment, which is called local preference by Zitelmann. A 2014 study showed that more than 60% of the properties held by German institutional investors are located in Germany, and only 1.4% are located in the Asia-Pacific region. Although the economic growth situation in the Asia-Pacific region was better than that of Germany at that time, and the investment process was also very simple, it still could not change the concept of most German investors. This situation does not only happen to Germans. Many surveys have shown that in countries such as the United Kingdom, Japan, and the United States, investors generally believe that their stock markets will perform better than those of other countries. Home bias can overlook lucrative overseas markets, costing investors potential gains, Zitelmann said. The research data in the book shows that in different investment markets, local preference will cause investors to lose 1.48% to 9.79% of potential returns. If it is a long-term investment with a large amount, the loss caused by this ratio will be very alarming. At present, no authoritative research can point out the reasons for the emergence of local preference. Some researchers in Germany believe that national pride may be one of the reasons. They found that when the country's patriotism is high, the amount of overseas investment will decrease. Home bias is an emotional bias that prevents us from developing an intelligent investment strategy. Zitelmann believes that don't think that the familiar market is a safer market. We must find more sufficient reasons for our investment decisions in order to stay away from emotional misleading. The fourth cognitive misunderstanding is the habit of using past market data as the basis for future investment, which is also known as investing with a rearview mirror perspective. Why is it called a rearview mirror angle? When driving, we look straight ahead, and we observe the road ahead through the front window. In the rearview mirror, you can only see the road you have already driven. The German stock market performed particularly well in 1998, and its stock price index exceeded the 5,000-point mark. The Germans bought like crazy, and they invested 35.3 billion euros in stock funds that year, compared with 1.3 billion euros 2 years ago. Then the index continued to rise until it began to collapse in March 2002. Over the next 2 years, everyone began to sell heavily. Investors who entered at the top lost at least 2/3 of their principal. In 2003, the German stock market began to rise again, and in 2008 it rose all the way again. Investors who bought during the 2002 trough made at least twice that. American economist Robert Shiller conducted a study in which he observed the stock markets of various countries in the world over a period of 5 years. He found that 2/3 of the strong stocks had 5 years of declines followed by 5 years of gains. And 94% of those stocks that had the biggest declines in the previous 5 years gained 122% in the next 5 years. Such a large change shows that it is very dangerous to choose to buy or sell based on the performance of the stock market in the past period of time. But that's what most investors did during these 2 ups and downs in German stocks. Psychologists have confirmed that we have a herd mentality, which makes people unwilling to disagree with the opinions of the majority of people around them. This kind of behavior that follows the crowd and is dominated by group instinct is a typical behavior of small investors in the stock market. Huge barrier to increasing wealth. The last misunderstanding is that when many people invest, they always think that they can beat most people in the market. On this point, Zitelmann is mainly aimed at the stock market. A 2012 data shows that 70% of private investors in Germany believe that their investment level is higher than the average level, but their income does not support this, and this kind of optimism can easily lead investors to failure. There was once an experiment of betting on dice. Before rolling the dice, people are always willing to place a larger bet, but when the dice is rolled but the points have not been announced, people are only willing to place a smaller bet. This experiment shows that people often feel that they can influence random events by their own strength. The points are random before the dice are rolled, and they can affect the points by themselves. When the dice are rolled and not displayed, people feel that they have no influence on the score. This phenomenon is called the illusion of control by scientists, and it is this illusion that causes many investors to overestimate their chances of creating wealth in the stock market. When it comes to buying and selling stocks, 95% of people are professional traders, Zitelman said. They make a living by studying the stock market and have a well-established system. It is almost impossible for individual investors to beat such a system, especially in short-term trading. Zitelman suggests that the best way to get rid of the illusion of control in stock market investing is to adopt a Ulysses strategy. In ancient Greek mythology, when Ulysses passed a small island by boat, he found a banshee who could lure sailors to danger with her charming singing. So Ulysses tied himself to the mast of the ship so that he could not move even if he heard the confusion of the singing, and at last he got out of the danger safely. The so-called Ulysses strategy is to formulate an investment plan on the premise that the market is uncontrollable by default. Regardless of whether the short term rises or falls, invest a fixed amount of funds in the stock market every month for long-term investment. Tie it to the mast to resist the risk of the market. Having said that, let's briefly review the second key content, which is to avoid 5 misunderstandings in order to increase wealth. The first is to try to avoid diversification of investments and choose a market that is well understood enough to make accurate predictions for concentrated investment. The second is not to think that low volatility investments have lower risks. The third is to get rid of the prejudice of local preference and invest with a broader perspective. The fourth is to avoid investment from the perspective of the rearview mirror and not to use past data as the basis for future investment. The fifth is to invest in the stock market. Don't overestimate your investment level and avoid the illusion of control. The third part. Finally, let's talk about the 5 characteristics that you need to have to create wealth. The first characteristic is to have an entrepreneurial spirit. In 2015, UBS and PricewaterhouseCoopers released a joint survey, and the results showed that most of the billionaires in the world did not inherit their wealth, but relied on entrepreneurship and investment. So what is entrepreneurship? Zitelman believes that the most important point is to have a more open mind. Surveys have shown that ordinary people believe that trying new experiences means taking risks. But more than 60% of German entrepreneurs are willing to try various new experiences. In the eyes of entrepreneurs, doing nothing is risky because it means missing opportunities. American psychologist Albert Bandura proposed a concept called self-efficacy, which refers to people's confidence in their ability to control difficult situations. The research of German scholars Rauch and Fraser shows that successful entrepreneurs generally have higher self-efficacy than others, and the more complicated the situation, the more confident they are. The second characteristic is to start a business cautiously. Many people tend to equate risk-taking with gambling, which is actually a misunderstanding. Just now we said that successful entrepreneurs dare to take risks. In fact, they are all carefully thought-out strategies, including ways to reduce risks. In the term and life cycle research, after 60 years of follow-up investigation, it was found that high scores and rigor are one of the conditions for entrepreneurs to succeed. Zitelman suggested that if you want to start a business, you must first give yourself a transition period. During the transition period, don't ignore the existing positions. People who can't handle their full-time jobs are more likely to fail in starting a business. The next thing to think about is the amount of capital needed to start a business, which is probably much more than imagined. There are too many accidents on the way to start a business, and the business plan cannot be set in stone, otherwise it will fail sooner or later. The third quality is to be honest. People always think that rich people get rich by dishonest means, and they can't get rich because they are too honest. This notion stems from a misconception that business is a zero-sum game where someone makes money and someone else loses. But a stable business relationship should be a deal that benefits both parties, Zitelman said. Buffett once bought a furniture store. On the first day, he asked the owner how much the store was worth, and the other party said $40 million. He sent the check the next day without doing any auditing of the accounts. The shop owner was taken aback, but Buffett said he trusted the shop owner even more than he trusted his accountant. For him, this store is worth the price, there is nothing false. Buffett also once said that when he hires people, He pays attention to three qualities: honesty, intelligence, and energy. Foremost among these is honesty. If employees are not honest, their wits and energy can ruin a business. The fourth trait is frugality. People often think that rich people like to live a life of luxury. However, some survey data from the United States and Germany show that most rich people do not like conspicuous consumption. They are used to repairing worn-out shoes and changing telecom service providers because long-distance calls are too expensive. This is because the successful rich will pay more attention to the appreciation of assets rather than consumption. The last trait is setting financial goals. Is it an unrealistic goal to make yourself $1 million? If you think it is, you have failed on the road to wealth creation. Researchers have found through surveys that the higher the goals that entrepreneurs set for the enterprise, the higher the subsequent growth of the enterprise. The first step towards financial freedom is knowing exactly what you want to achieve and why. One tip Zittelman gave us was to write down the financial goals you want to achieve in the next 10 years. He believes that people always overestimate what they can do in 1 year and underestimate what they can do in 10 years. The research data obtained by American scholar Colden and others in 2008 shows that many great achievements of mankind have been completed in 10 years, so 10 years is just right for achieving financial goals. After setting 10-year goals, you can subdivide the overall goal into small goals and strive to achieve them every year. If you want to make $1 million in 10 years, then generally speaking, it is unlikely that you will make $100,000 a year, but you may make a small amount of money for a while, but then the income will show up. Exponential growth, so reasonable target values at each stage can be set accordingly. According to Zittelman, the current financial situation reflects the current way of thinking, and if we do not change the latter, it is impossible to create wealth if we are always afraid of failure and feel that we are not good enough. Now let's briefly review again. The first point is what wealth is. If we equate wealth with a large amount of income, we will never enjoy financial freedom. Only by increasing the value of wealth do you not have to worry about it being exhausted. The second focus is to learn how to increase wealth by breaking the 5 inertial cognitions. The first is to try to avoid diversification of investments and choose a market that is well understood enough to make accurate predictions for concentrated investment. The second is not to think that low volatility investments have lower risks. The third is to get rid of the prejudice of local preference and invest with a broader perspective. The fourth is to avoid investment from the perspective of the rearview mirror and not to use past data as the basis for future investment. The fifth is to invest in the stock market. Don't overestimate your investment level and avoid the illusion of control. The third point is the 5 qualities that should be possessed in creating wealth. The first is entrepreneurial spirit, the second is rigorous entrepreneurship, the third is honesty, the fourth is frugality, financial goals. This is the end of this episode of the show. What do you think about it differently? Welcome to leave a message to discuss with everyone. Hey, if you like our channel, please subscribe us. Haha, remember to like it.